Hey, what's up, my friend? How are you doing? Alright, so today's video is definitely a little bit shack. Why is that? Because I was recording the video earlier and then I realized that I was using the wrong microphone, right? Somehow the computer sometimes it get crazy and it selected the microphone from my webcam, and that's the worst sounding of all because it made me sound very muffled, like Mickey Mouse, Donald Duck, that kind of stuff, right? And you can't even hear what I'm talking about along that line. So I decided, you know what? Let's do this all over again. So I recorded the full 12-13 minutes video, had to press delete painfully, and re-recorded everything with my this Blue Yeti Who's the Boss microphone. So yep, finally got it done. So yeah, a little bit longer to produce, right, for today's video. So anyway, right, please watch it since a lot of effort clearly has been undertaken to produce today's video. And since now is the first week of April, right, what I like to do is to share with you a broad overview of what's going on in the financial market. So we cover forex, indices, bonds, commodities, and all the different sectors, right? So all in all, right, definitely good to know what's going on in the financial markets right now, right? Don't have to pay attention to news, fundamentals, analysis, opinions, blah blah blah. Just stay true to price, right? And I would say that's the most important thing you should do as a trader. So all this and more in this week's video. I'll see you there. Okay, so first thing first, right? Let's talk about euro dollar, shall we? So again, I'm not going into too much details about the trade I took on euro dollar. If you want it, look at last week's video. I pretty much covered it, right, in much more in depth, right? So this week's objective is simply to share with you the broad overview of what's going on in the financial markets. So euro dollar, right? I am bullish on this, right? Some of you, if you can't look at it, you do not know why, Rayner. Why are you bullish, right? Just pull out your 200 MA. Right, this is the 200 period moving average. You can see that clearly the market is above it. So whenever the price is above the 200 period moving average, right, my bias is to stay long. Okay, so I'm bullish on euro dollar. If you're looking on the sidelines, how can I enter this trade, right? Couple of trading setups is for the first one is the market retest towards the highs, forms a build up, consolidate, and it breaks out, right? You can look to long the break of the highs. Alternatively, if the market comes back lower and retests back this area of support, right, comes down lower and gets rejected and closed bullishly, that's another valid setup to go long. In fact, this was what happened right previously, which was why I went long on euro dollar. Okay, so moving on, pound dollar, pretty much the same as euro dollar, right? If you flip those two charts, they are somewhat correlated between one another, right? So my analysis on euro dollar and pound dollar is the same. All right. So moving on, Aussie dollar, right? This is where things differ slightly. So Aussie dollar is more of a range at this point in time, if you ask me, or if you look at what you're seeing right now on this chart, it's more of a weak trend, right? You can see a series of higher lows, right? But it's not really in a strong trend. So at this point in time, right, for Aussie dollar, right, I don't really have any setup to trade this. So this is a perfect example of knowing when to stay out and when to stay in, right? This is an example of I'm going to stay out of this market. I have no interest to trade it, right? And I'll just move on. For New Zealand dollar, you can see that this market is more of in a range between 74 cents and 68 cents at this support over here. So what I'm seeing over here is let me just zoom in a little. So you can see that this market is forming a series of lower highs into this area of support, right? A descending triangle. So what could possibly happen is that the market trades lower, starts to consolidate and break down, right? So if this happens, right, I'll be looking to short the New Zealand dollar because, as I've mentioned, right, I even did a video on this, right, on the ascending and descending triangle, because this is a sign of weakness. Why is this a sign of weakness? Because if you think about this, right, if the market is strong, right, why is it always being suppressed by this invisible so-called barrier on down on its neck, right? You can't trade any higher. Stay down, stay down, stay down, right? So you can see that series of lower highs, right, that consistently make this market stay being compressed, right? So this to me is a sign of weakness, right? The buyers are unable to push price higher, and I won't be surprised if the market breaks down lower. Okay, so New Zealand dollar bearish on this. Moving on, dollar Canadian. This is a very interesting market, right? So why do I say that? Is seldom, right, you would hear Rayner say, hey, you can go, both long and short on this market, right? But for dollar Canadian, right now, I would say, it's not wrong to go either long or short. Okay, because my bias on this right now, it can be long or short. So let me explain why. So let's talk about long. Why am I okay to go long at this point in time? I think let me just adjust this down a little bit, right? Okay, to take into consideration this swing low over here, right? Although it breached this previous resistance, right? But remember, support resistance, they are an area on your chart. So if I want to better represent it, right, what I would do is to draw a box shaded area, right? So by right, technically, right, if you really want to get anal about this, right, support resistance is an area, right, and it's better. I mean, it's one way you can consider doing it is to highlight it as area, boxes, rectangle on your chart. I don't do it because I find it very messy. I like it simple, minimalist, right? That's the way I approach it. So I usually just have one line on my chart, even though I treat it as an area. So anyway, right, you can see that this dollar Canadian, the market was in a range. Then it did break out and now retest previous, resistance turn support. So when you look at the 4-hour time frame, right, notice that this market is pretty much consolidating over the last few days as well. As you can see that this is formed even a smaller range over here. So what could possibly happen is that if the market approaches the highs, forms a build up and break out, I would be inclined to go long. On top of it, right, you can see where you are in the big picture. You're pretty much, entering near the pullback towards this previous resistance turn support, and if it breaks out higher, it could possibly resume its uptrend. So that's one, and that's why I said I'm okay to go long. Number two, if you look at this chart, notice that this market is at this area of resistance, right? Whether you want to decide, I mean, it really depends on how you interpret it, whether the resistance is broken or the market is still within an area of resistance. So if you are the second camp who thinks that hey, this market, or whatever reason, maybe fundamental or whatever extra analysis you have behind, and you think that dollar Canadian still has room to go down, right? To me, right, you can actually also trade it towards the downside, because if you look at it on the 4-hour time frame, this market is forming a potential inverse head and shoulders pattern, right? Notice this potential right shoulder that's being formed. So if the market comes down lower, forms a build up, and it breaks down, right, I would say that's another possible reason to be short. So this is why I said that hey, dollar Canadian, this is a market that you can either be long or short depending on how the market structure unfold itself. I don't usually say this, but hey, this is just happened to be one of the case. It's a good learning lesson on how you can actually be having a long or short bias for this market. All right, so this is dollar Canadian. Moving on, let's talk about dollar Sing. Right, I think this is another market that presents a trading opportunity, right? You can see that this market clearly is in a downtrend, right? You don't really need to be Einstein to see this, right? You can see seriously, right? Lower highs on this chart. You can't decide, you can't see, pull out your 200 MA, the price is below it. Bias is to stay short. All right, so anyway, what's the setup that I'm looking at? So this is actually similar to the New Zealand dollar setup, right? You can see a series of lower highs coming into this area of support, right? A descending triangle. So again, right, you can see that the coil seems to be getting tighter and tighter. Volatility is shrinking. So if the market can break and close below this swing low, right, I'll be inclined to go short on dollar Sing in anticipation that this trend would continue towards the downside. Okay, so this is for dollar Sing. Moving on, right, let's talk about the indices, right? So the S&P, okay, you can see that the S&P, right, volatility, okay, let's go step by step. Volatility, right, historically, right, let's say over the last few months, it has been relatively low, right? Just look at the range of all the candles, right, it's pretty small. What happened is that when the market spiked down lower, volatility, right, has, pretty much changed drastically, right? You can see that volatility has picked up, right? If you can't see this, right, just pull out the average true range indicator and notice, right, volatility, right, previously has been pretty low, right? The lows over here, and then looking back, it pretty much spiked up higher. So volatility has picked up. So what is the implication? Very simply, right, if you're a trader that always use a fixed stop loss, right, like let's say if you trade the forex market, let's talk about S&P. If you use a fixed $5 stop loss, a fixed $10 stop loss, right, when it may work, right, when volatility is pretty constant, but when it spiked up massively, right, that stop loss, right, isn't enough for your trades because you're not giving it enough room to breathe, right? So if you look at this chart over here, let's say the market historically, right, S&P, the volatility, right, somewhere it's about $20. So if you use a $20 stop, a $30 stops, it might be enough, right? Because after all, on a day-to-day basis, it doesn't exceed $20-$30. But when now it's spiked to more than $50, $55, right, you can see that how your $20-$30 stops will get eaten alive, right? And many traders make this mistake, right, of using this fixed dollar amount as their stop loss, right? Thinking that, it's going to work for all market conditions. No, it doesn't work that way, right? When volatility picks up, right, your static stop loss is going to get eaten alive, right? So bear this in mind, right? So moving on, right? S&P, right? My bias is still towards the long side. No doubt, I noticed that volatility has picked up. This will be the area I'm looking for. If the market comes back towards this area of support, right? It gets rejected strongly, I'll be inclined to go long. For example, like this, very strong, obvious price rejection. Okay. Another thing to take note is that for the big picture perspective is that, the S&P, you can see that historically it's been a huge bull run, right? So schematics, right, is what I call a advancing stage, right, where the market makes a nice uptrend. But no uptrend lasts forever. Eventually, right, it has to, correct or reverse, right? So usually what happens, right, more often than not, is that the market doesn't, reverse on a dime like this, right? It happens, right? But more often than not, right, the market tends to absorb the prevailing move, the earlier move, right, and then reverse. So you see, then it's in an uptrend, then it doesn't reverse, it goes into a range, right? Then finally it breaks out of the range, right? Then that's where the downtrend continues. So this, right, if you project this so-called schematic onto the chart of S&P right now, this lows over here, right, I will reference it at around this level over here. If the market breaks, right, below this level, right, I would say, right, possibly you can look at, the S&P moving into a downtrend with lower prices in the coming weeks or months, right? So this is S&P, right? My take on it is still bullish, but you want to definitely pay attention towards the 2550 area on the chart, right? I call this the last line of defense for the bulls, okay? So that's for the S&P. Same thing for NASDAQ and Russell, right? So I'm not going to, go into too much details because, they're just pretty much looking the same. So moving on, right, let's talk about Brent crude oil, shall we? So Brent crude oil, right? Again, the trend, what is it? In an uptrend, right? And notice that this market is forming a potential build up at this highs. Again, this is what I like to see, right? Whenever I talk about breakouts, break up or down, right? I like to see build up being formed, right? Seldom almost never you hear me that, that the market, let's say it rallies from here, break above the highs, I go long at this point in time, right? From a discretionary standpoint, right? I seldom trade in this manner. Why is that? Because if you think about this, right, if the market suddenly rally all the way towards this highs, it breaks out, right, where is the nearest place you're going to put your stop loss, right? The nearest logical place is below this swing low. So you can see that it's pretty darn large. Okay, so from a risk to reward standpoint, it's quite poor. Now, however, if you let the market forms somewhat of a build up, right, like this over here, right, there's a new structure that you can reference to, and let's say the market this time around, it still breaks out, but this time around you have this swing low as a structure to reference from. Notice that your stop loss, right, this time around, it's much tighter, right, compared to from here all the way down to somewhere here, right? Can you see the difference in the stop loss, right? One is much tighter, one is much larger. And as you know, right, with a smaller stop loss, right, you can put on a larger position size and still keep your risk constant. Okay, so that is for crude oil, right? A potential build up is being formed. If it breaks above the highs, right, I will be inclined to go long on crude oil. And last but not least, right, silver. Okay, so silver, right, this market, you can see that long term is still somewhat in the range, but my bias is still towards the short side because you can see that this market is forming a series of lower highs. Okay, so it's pretty much a very, pardon my bad drawing, it's pretty much in a long term descending triangle. Okay, so I'm looking to short silver, and a couple of things to look at is if the market can retest back to this area of resistance, get rejected, I'll be looking to short this, or alternatively, right, trades lower, form a tight build up and breaks down. That's another way you can short silver as well. Okay, so this is what I'm looking for, and with that said, right, let's do a quick recap to what I've covered today. Euro dollar, pound dollar, bullish. Aussie dollar, more of a range. New Zealand dollar, bearish. Dollar Sing, right, the dollar against the Sing, bearish. Dollar Canadian, quite interesting. I say can either be bullish or bearish. Two setups could potentially unfold. S&P, long term still bullish, but I explained to you that the 2550 will be a level to look for, because if it breaks, right, then I will switch from bullish buyers to bearish buyers. Brent crude oil, bullish. And last but not least, silver, right, bearish towards the downside. Okay, so that's it, right? You now have a complete idea of what's going on in the financial markets. Oh, and one more thing. Oh no. I left out the bond markets, right? So let's do a quick quick one on the bonds, right? So let's look at the 10-year bond market. Straightforward. Price has break below this area of support, right? So needless to say, right, bias is towards the downside for bond. Okay, so again, if you just pull out the 200 MA, price is below it, right? Bias is to go and look for short setup. So this will be definitely a level to look for potential shorting opportunity for the 10-year bond. Okay, and that's it, right? I finished the bond as well. So now you have a good idea of what's going on. Forex, indices, bonds, oil, silver, and stuff like that. So with that said, right, I have come to the end of this week's market analysis. If any feedback, comment, just let me know below and I'll get back to you. And if you enjoyed this video, right, doesn't harm to hit the like button and even subscribe, right? So you always stay up to date on all my latest videos. You never miss an update. You don't miss my voice, don't miss my face and whatnot. All right. So with that said, I'll talk to you soon.